Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028-201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
Well, it is already a pretty darn good week. Only through one day, but I heard this morning that we're going to be getting a jobs report later this week, Thursday to be exact. The September numbers will finally be known. Not the jobless rate. I'm not getting that. We will get job numbers, though, from the month of September. Just a month and a half late. But who's counting? I'll take it, though. I'll take some jobs data. All right, welcome, everyone, to Wilmington Mortgage. I'm the aforementioned host of this podcast, Tyler Cralle, loan officer at Town Bank Mortgage right here in Wilmington, North Carolina, talking about the stories that are moving rates and could be moving rates. But usually, kind of we wrap the day up, give you an idea of what happened that day in the bond markets. And so what happened today? Nothing, really. I think the yield on the 10-year is down not even a full basis point. I can't even say 1 basis point. It's down 0.9 of a basis point. So not a lot of movement. Nothing really going on today. We did get some comments from the Fed Vice Chair Philip Jefferson. We'll talk about that. But I do want to talk about housing. We're hearing all these gimmicks out there about possible ideas, 50-year mortgages, portable mortgages, assumable mortgages. But there's a pretty good piece. It was in the New York Post and over at AEI, where the gentleman works, Howard Husock, who says we need a Marshall Plan for housing. So we're gonna get into that. But the first story we're gonna get into is Fed Vice Chair Philip Jefferson gave a speech on Monday talking about monetary policy and what's going on at the Fed, but he didn't really give any ideas. Everyone obviously is wondering what is going to be happening at the December meeting. This is truly one of those decisions that we really have no idea. I mean, it's been a while since we've really kind of been in the dark. Usually at this point, I feel like we would be at least getting some sort of guidance on what could be happening. But I mean, it really almost seems like it's going to be a coin flip at the next Fed meeting. And so we had the Fed Vice Chair, Philip Jefferson, talking today about monetary policy, but did not give any guidance whatsoever on what could be happening at that final meeting of the year in December. He was speaking at the Kansas City Fed. Jefferson emphasized that the central bank's posture must reflect shifting risks across inflation, employment, and growth, as always, saying the evolving balance of risks underscore the need to proceed slowly, framing the Fed's job as a trade-off management exercise rather than a race towards lowering borrowing costs, which, once again, that's what their job is. He added that policy is still somewhat restrictive, meaning that we will be seeing more rate cuts, but the Fed has moved rates closer to that neutral level that neither restricts nor stimulates the economy. I do like that he sort of gave us the idea of what the neutral rate was. Like, yeah, we figured that. That the neutral rate means it's not restricting or stimulating. But I do like that he spelled that out for us. Jefferson's remarks were deliberately non-committal. In fact, Nick Timorous over at the Wall Street Journal, a.k.a. the Fed Whisperer, commented on this speech saying, quote, he did little to build the case either for a long time out on rate cuts or for a rate cut at next month's meeting. So still kind of in limbo as to what is going to be happening in December. Just to give you an idea, the CME Fed Watch tool shows a roughly 60% chance the Fed does not cut rates at the next meeting. Now, that is very interesting because 1 month ago, October 17th, 6% chance that they were not going to cut. And now we're at 60%. So a lot has changed. Specifically, of course, that Fed meeting, October 29th, my birthday, if you remember, we had Jerome Powell saying like, ooh, I don't know if we're going to cut in December. And that really kind of set things off. Rates have been on the rise since then. And that's why we're now about 4.14% when we were, pretty well under 4 there at the end of October. So we don't know. We don't know what's going to be happening. That was really the only piece of news that could possibly move markets. And because Jefferson really didn't say anything, markets did not move. Hence, barely down 1 basis point. So let's get to the big story, in my opinion, of the day. And this is the ongoing discussion about how to fix the housing market. Something I keep telling people who are not in the housing market is that housing has essentially kind of been in a recession for a couple of years. The fact that we're looking at mortgage demand at, 10, 20, 30-year lows, existing home sales, 10, 20, 30-year lows. We are at depressed levels. There is no doubt about that. It doesn't mean that there aren't people who are thriving. There are people who are doing well. That's not the case. I'm just saying compared to where we were before the pandemic, things are down. In fact, what's funny about all of this is that this talk about 20, 30-year lows, that's worse than 2008. So that's something else to take into account with what's been happening with housing. And so finally, you're really starting to see people kind of rise up. And you know that it's reaching the upper echelons of power because, famously, what was it, 2 weeks ago, you had President Donald Trump talk about a 50-year mortgage. He sent that tweet out with a picture of him and FDR with a 30-year mortgage, which, of course, I noted here on the show that what was funny about that was that Congress didn't actually allow the 30-year mortgage until I think it was like 3 years after he died. So I'm not sure why FDR was getting credit for that. But then Trump had said 50-year mortgage. And that's been kind of panned by most people. A lot of people pointing out that, sure, you'd have a little bit of savings, $100 to $300 a month, but you'd end up paying twice as much in interest. And, 50 years just sounds so ridiculous with regard to a human lifespan. And so it's been kind of, a lot of people were not happy about it, kind of laughing at it. And so then recently we have heard this discussion about a portable mortgage. FHFA Director Bill Pulte tweeted last week that the administration is, quote, actively evaluating portable mortgages. And this would essentially be a product where if you buy a house, you get a rate, and then you say you want to buy another house and you want to keep that mortgage, you can take it with you. This is different than assumable mortgages. Assumable mortgages would be something that stays with the house. So this, you don't really see these with conventional. I think VA, you can see some of those where basically, I buy a house, let's say I get a great rate, 5% or whatever, and then you want to buy the house. I could say, you know what, you can assume this mortgage. But portable mortgages are something very interesting and not that great of an idea. Jake Krimmel told Fox Business, he's a senior economist over at Realtor.com, said that portable mortgages collide directly with the way we do mortgages in the United States, saying, quote, the U.S. mortgage system is built on securitization. Basically, where we take all the loans and package them together and create those, if you watch The Big Short, those tranches of loans, and it's supposed to help spread the risk out because the likelihood of one of these giant bonds, all of them defaulting, seems completely ridiculous. Well, it seemed even more ridiculous before 2008, which was sort of the problem. But they said where loans are pooled and priced based on specific properties backing them. Because the loan is tied to the collateral, aka the original home, the collateral and therefore the risk profile of the entire pool would change midstream if a mortgage followed a borrower to a new property. And so that's the big problem, is that changing properties, you're changing the risk parameters. And once again, even if we were to start allowing this, and they said, okay, we're going to open this up. You have to allow this as, lenders. You have to allow portable and assumable mortgages. This would all be for the mortgages going forward, not for any of the ones that already exist. There's no way anyone's going to let you retroactively go back and change the terms of a deal. There's no way. What would actually end up happening, let's say we did allow that, was you could see a massive sell-off of mortgage-backed securities that would do what? It would skyrocket the prices would collapse, yields would skyrocket, aka rates, and it would actually push mortgage rates up. If nobody wanted to buy mortgage-backed securities, we'd have a very big problem on our hands. And so these just do not seem like solutions. They're gimmicks. They're kind of flash in the pan. They're not what we need. Now, however, let's talk about something serious. As I mentioned, Howard Husock of AEI says the U.S. needs a Marshall Plan for housing. Of course, talking about the famous Marshall Plan, the rebuilding of Europe after World War II. That's what this is sort of based off. We need to rebuild, I guess, the housing market, sort of the way to look at it. Husock cites AEI's Ed Pinto saying, instead of a 50-year mortgage, what we really need is a 20-year mortgage, which will allow homeowners to build equity faster and become debt-free earlier. Saying, quote, when the 30-year term loan leaves the most homeowners saddled with another decade or more of payments, the cash flow freed up from a paid-off shorter-term loan is available to fund a child's education and later, of course, turbocharge retirement. And one of the ways to sort of deal with possibly the higher payment, which you would have, same reason why 15-year you have a higher payment than a 30-year, would possibly be first-time tax buyer credits. One of the scenarios out there. He also argues we need some changes to the CFPB. We need to start allowing maybe more exotic loan products. I know a lot of people are scared of that because of what happened in 2008, but in some cases, those loan products do make sense. Remember, 2008 wasn't because of crazy loan products. I mean, it didn't help things, but 2008 was lending standards. Plain and simple. Bad appraisals, lending standards. We don't have that problem right now. So it's not scary to bring back different kinds of loan products that can help people get into houses. It's not scary. Once again, if it becomes the standard and we start pushing people towards these products and it's not in there, that's a different story. But in some cases, it does work for some people. And the fact they're not even on the table because of a lot of the rules and regulations that exist out there, it's not helping those borrowers. So once again, shorter-term mortgage and maybe some more sort of exotic loan products. And then, of course, the real factor in all of this, supply. We need more supply. The federal government needs to do a job of sort of pressuring local municipalities to allow building, allow smaller houses, starter homes for those first-time home buyers, which just do not seem to exist right now. And so I'll put this article in the show notes so you can check it out. But, I mean, this is really what we need to be looking at. We need to be looking, once again, at, I think, tax credits. So that will help, people afford a loan, along with in some cases, not everyone. I know people are going to go, oh my, look, he wants 2008 all over again. Looking outside the box. So it's not just 30-year conventional products. Sometimes it makes sense to go with an ARM. Sometimes it makes sense to go with something else. And just having that available is a good thing. Not the majority, but in some cases. And then on top of it, once again, supply will help bring down home prices and provide those smaller homes for home buyers, especially first-time home buyers. And so, once again, these are like legit ways that we can solve this housing crisis, not like 50-year loans and portable and assumable mortgages that, like I said, just do not make sense in our current environment, unless they're trying to completely change the mortgage markets. If not, we have a little bit of a problem there. All right. I think that's it. We got to go. Like I said, not a lot going on with mortgage rates on this Monday. However, later this week could be a bigger deal with that September jobs report coming out. We will see. I'm very excited for it. I know you are as well. So we're going to be talking about it here on this program. Could potentially see some rate movement. We'll also update you as we get more information about a possible or what's going to happen at that December meeting. Right now, it's looking like likelihood of not being a cut. We hear any different, we'll let you know. But like I said, you guys enjoy your Monday. We'll be back here Tuesday for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.